This is a very active time in the market, I don't have to tell you. But this week, the VIX crossed 65, which is the fourth largest measure of volatility in the market, really in the last 40, 50 years. And I've been around for all of them. So it's fourth after 08-09, the tech and telecom bubble in 2000, and 1987.
The global economic outlook remains uncertain, with prominent investors like Warren Buffett and Cathy Wood taking cautious stances. Buffett's Berkshire Hathaway has been steadily increasing its cash reserves, which are now approaching $300 billion. This significant cash pile, reminiscent of Buffett's strategy before the 2008 financial crisis, has raised concerns among market observers about potential economic turbulence ahead. Berkshire Hathaway's recent actions include selling off large portions of its Apple stake and reducing its position in Bank of America. In the second quarter alone, Berkshire sold $75.5 billion worth of stock on a net basis, pushing its cash reserves to a record $276.9 billion. This substantial liquidation of assets suggests Buffett may be anticipating a market downturn or seeking to position Berkshire for future opportunities. Meanwhile, Cathy Wood's ARK Invest has also been making strategic moves. The firm recently sold 108,751 shares of its ARKB Spot Bitcoin ETF, valued at $6.9 million, as part of a fund rebalancing effort. This sale occurred alongside increased divestment of Coinbase coin shares, with ARK offloading an additional $14.7 million worth of the cryptocurrency exchange's stock. Wood's actions align with her belief that further market volatility may be on the horizon. Despite the recent market rebound, both Buffett and Wood appear to be preparing for potential economic challenges. Their cautious approaches, characterized by increasing cash reserves and strategic divestments, suggest a level of skepticism about the current market rally's sustainability. Now again, let's start by listening to Cathy Wood, CEO of ARK Invest, who expressed concerns about the US economy, the Fed's activities regarding news reports, and the risk of a recession, as well as the responses of stocks and other markets.
This is a very active time in the market, I don't have to tell you. But this week, the VIX crossed 65, which is the fourth largest measure of volatility in the market, really in the last 40, 50 years. And I've been around for all of them. So it's fourth after 08-09, the tech and telecom bubble in 2000, and 1987. Now, what does this mean, this volatility alert? It usually means the market is meeting a cathartic moment, or is in a cathartic moment. And it usually means something is changing. And as you know, we have believed for quite some time that the U.S. economy, and maybe the global economy, has been going through a rolling recession ever since the Fed started raising interest rates. Well, the other thing that was happening during that time, apparently, was an increase in the carry trade involving borrowing yen, so really shorting yen, and buying dollars and investing them into higher yielding assets than in Japan, so playing the spread. The other reason this became a very widespread trade is the yen has been depreciating. So shorting yen meant that the investor or the speculator was benefiting from the yen going down. Well, that changed abruptly this week as the Bank of Japan increased rates more than expected and seemed more determined to continue increasing rates than many people expected. So apparently, lots of margin calls and a sell-off in a lot of assets. and now the VIX has calmed down. Now, we're not sure if the carry trade has unwound completely. JP Morgan is saying we're halfway there. So perhaps we'll see some more volatility, but I do believe that the Fed now is on high alert because the stock market seemed to be encouraging the Fed to hold tight, higher for longer, make sure that inflation was out of the system. And as you know, we've been saying for quite some time that inflation is unwinding much faster than we're seeing in the traditional indexes. Right now, the CPI is at 3.1, but by other metrics, we're seeing prices fall. And we would not be surprised to see prices fall a little more broadly as the consumer weakens. Now, why is the consumer going to weaken or continue weakening? We believe it's because corporations are losing pricing power. And in order to salvage margins, they're going to be doing two things. They will be laying people off, and they will be accelerating moves to increase productivity. So the unemployment rate will go up. That certainly is getting the Fed to change its spots, as we're listening to Chairman Powell. And I think now that household net worth being hurt by the stock market going down is another reason that the Fed is going to relent. Now, one last thought here. Interest rates coming down should be very positive for the equity markets, but they will not arrest a recession very quickly. In fact, if consumers and businesses know that interest rates and maybe prices are coming down, what will they do? They will wait. Now, the market in its wisdom, we believe, is already understands much of what I have told you. And so we do think that lower interest rates, when this carry trade is completely unwound, that lower interest rates are going to be the defining factor in terms of a rotation in the market away from a very concentrated group of stocks to a much broader based group of stocks. And as I just mentioned, innovation solves problems. So productivity gains are certainly what we believe is going to happen as AI proliferates throughout the global economy. So we just wanted to give you some insights based on lots of years of experience, having experienced these volatility, cathartic moments. It usually means there is a rotation into a new kind of thinking underway. And we do believe that will play out during the rest of this year.
Here you can see Cathy Wood, CEO of ARK Invest, is very vocal about her belief that a significant market shift is on the horizon, one that could reshape the investment landscape and challenge the dominance of the Big Seven tech firms, which includes Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla. In recent interviews and ARK Invest publications, Wood has emphasized that the upcoming market changes will be transformative and potentially frustrating for traditional investors. According to Wood, the next wave of innovation will be driven by the convergence of several key technologies, primarily artificial intelligence, AI, blockchain, and robotics. In ARK Invest's Big Ideas 2024 report, the firm projects that these disruptive technologies could increase the global equity market capitalization from the current $19 trillion to an astounding $220 trillion by 2030. Regarding the potential market crash, Wood believes it will be a necessary reset that will separate truly innovative companies from those riding on past successes. She explained in a recent ARK Invest webinar, this crash will be frustrating for many because it won't follow traditional patterns. It will be about technological obsolescence rather than just economic cycles. The Big Seven have had an incredible run, but history shows us that market leadership doesn't last forever, Wood stated in an ARK Invest podcast. And that's all for today. If you enjoyed this video, please give it a like, subscribe to our channel, and hit the notification bell so you don't miss any future updates. Thanks for watching, and stay tuned for more.